Hello, my friend. This is Lynn from MathPhDTrading. Since last week's first video, I have gotten 200 plus views, 38 subscribers, plus some nice feedback. So thank you very much for your support. I'm working on quite a few videos right now, and one idea is to run an experiment on earnings trading. Let me tell you all about it in this video. First, why do we want to trade on earnings? When the quarter plays out and the company announces whether they actually missed or beat the earnings predictions from last quarter, uncertainty and volatility exist. This huge uncertainty causes high implied volatility, which means a higher premium. Conversely, when earnings are released, the market has a relatively better understanding of the company's future, so uncertainty typically dissipates. The volatility naturally decreases as uncertainty fades. This decrease is called a volatility crash, and it lowers an option's price. Another reason we trade on earnings is because of the liquidity of the trade. Usually the strategy is to open one trade on earnings the day before earnings and to close it the next day. So even if you only earn 0.1% of the principal, your annual rate of return is 20%, since there are 200 trading days in a whole year. Since I mentioned implied volatility, I want to cover a bit of the basics on the value of an option trade. The trade value consists of two parts: intrinsic value and extrinsic value. Intrinsic value is easy to calculate. If the trade is out of the money, the intrinsic value is 0. If the trade is in the money, the intrinsic value is the difference between the stock price and the strike price. Extrinsic value is composed of time value and implied volatility value. I don't know the exact formula to calculate them, but let me roughly do the calculation for you below. On 2024, January 19th, Tesla, with an IV 53%, closes at $212.19. So a 212.5 put trade that expires on next Friday, January 26th, has a premium, say, $7.2. So the intrinsic value is 31 cents. That will get us extrinsic value $6.89. And we have an approximate way to calculate the time value. So the theta time value factor shows here it's 0.61, that is 61 cents. And there are still 5 days left in the next week. And actually, usually the time value factor increases as the time become closer to the expiration date. So we can say that the time value is at least $3.05. And that means that gives us the IV value is close, but less than $3.84. Still, that's like 50% of the premium. And this IV value would shrink dramatically after Tesla earnings. That means even if Tesla moves down a few dollars, you still profit from this trade. And that's why there is an advantage called IV crash. So my experiment runs from 2024, January 22nd, next Monday, to 2024, February 29th, altogether 5 weeks. The criteria for stock is among all of my 50 stocks, any stock that with IV larger than 30%. The trading strategy is sell put right before the market close on the earning day with delta in between minus 0.16 to minus 0.20. And the expiration date is that Friday. I would close the trade next morning right after the market opens, which means I have to get up before 6:30 a.m. And regardless of the trade status might sound easy, it's only easy if you are winning from the trade. If your trade is losing, which means your strike price now is at the money or in the money, your brain will try to persuade you not to close the trade. Some of the thoughts are, the fluctuation of the stock is huge right now. Maybe I can wait until the stock is up. It's near the money right now. What if I just wait until Friday to see through the uncertainty and take advantage of the dissipating time value? So all these are valid thoughts, and it might work out and it might not. The key here is to be disciplined and trust the process. We are not day trading. We are also not doing theta, time value trading. We're doing Vega, IV trading. Being mechanical makes things easy and helps you to sleep better. At least this is my experience. I will sell puts on these 4 stocks next week, following my strategy. I don't have Microsoft here because its IV is less than 30%. I figured the reward is too small compared with the risk. I am a bit apprehensive, to be honest. I have practiced this strategy before, and as far as I remember, there are more gains than losses. But I didn't calculate, so I don't know how successful it was. So this will be a learning opportunity for all of us. If you think that some other stocks are good for earnings, please comment below. For the next 5 weeks, every Sunday, I will make a short video to update you on this experiment. If you wonder what happens, tune in next Sunday. And don't forget, like and subscribe. #MathPhDTrading. Bye for now.